what are the differences between, what is the difference between gross and net? Gross and net. The gross and net, the difference is depreciation. Depreciation means the consumption of fixed capital or user cost or the amount of wear and tear or the cost of repairs and renewals. This is called depreciation. So first, gross is equal to net plus depreciation. So we add depreciation to net, then we get gross. On the other side, net is equal to gross minus depreciation. We subtracted depreciation from the gross, then we get net. So the difference between gross and net is depreciation, consumption of fixed capital. Next, the prefix net can be used in two areas. The prefix net can be used in two areas. First one is net is equal to gross minus depreciation. First one is net is equal to gross minus depreciation. Examples: net domestic product is equal to gross domestic product minus depreciation. So GDP minus depreciation is equal to NDP, net domestic product. Second one, NNP, net national product. Net national product is equal to, so GNP minus depreciation. Gross national product minus depreciation is equal to net national product. Next, NNDI, net national disposable income. Net national disposable income is equal to gross national disposable income minus depreciation. Then we get net national disposable income. This is one case. What? The prefix net can be used in two areas. This is the first case. Second one is net is equal to receipts minus payments. Receipts minus payments. Second one is, so net indirect tax, that is NIT. Net indirect tax is equal to indirect taxes minus subsidies. Indirect taxes are service tax, sales tax, nothing but GST, goods and service tax. So indirect taxes minus subsidies, then you get net indirect taxes, NIT. Next, net factor income from abroad. Net factor income from abroad is equal to net factor income from abroad minus net factor income to abroad. So from abroad minus to abroad, that is called net factor income from abroad. Next, net exports. Net exports is equal to exports minus imports. Exports minus imports, that is called net exports. Next, net current transfer rest of the world. Net current transfer rest of the world, that is equal to net current transfers from rest of the world minus net current transfer to the rest of the world. Net current transfers are remittances, foreign aid, foreign grant, pensions, gifts, donations, and scholarships. Those are all called net current transfers. So net current transfers from rest of the world minus net current transfer to rest of the world. Then you will get net current transfer rest of the world. So this is one difference and this is another one. Next, what is the difference between domestic and national? The difference between domestic and national is net factor income from abroad. Net factor income from abroad. So domestic is equal to national minus net factor income from abroad. Then you will get domestic. On the other side, national is equal to domestic plus net factor income from abroad. Then you will get national. National one is the bigger one, domestic is the smaller one. Next, what is the meaning of net factor income from abroad? Net factor income from abroad means it is the difference between receipts and payments. So net factor income from abroad is equal to receipts minus payments. So in other words, net factor income from abroad is equal to aggregate amount that a country's citizens and companies earn abroad minus aggregate amount that foreign citizens companies earn in that country. This difference is called net factor income from abroad. Next, another formula. Net factor income from abroad is equal to factor income earned by the domestic factors of production employed in the rest of the world minus factor income earned by the factors of production of the rest of the world employed in the domestic territory. This difference is called net factor income from abroad. So, in other way, net factor income from abroad is equal to net compensation of employees plus net income from property and entrepreneurship plus net retained earnings. So, we add these three, then you will get net factor income from abroad. Next, what are the differences between production taxes and product taxes? What is the difference between production taxes and product taxes? Production taxes are paid in relation to production. In relation to production. For example, land revenue, stamps and registration fee, pollution tax, provision tax, factory license fee, etc. etc. Best example for production taxes. So are paid in relation to production. On the other side, product taxes are paid per unit of product. Product taxes are paid per unit of product. That is sales tax, service tax, or customs duty, or GST. These are all paid per unit of product. Those are called product taxes. Next, another difference is what are the differences between production subsidies and product subsidies? Production subsidies and product subsidies. The production subsidies are given in relation to production and independent of the volume of actual production. They are given in relation to production and independent of the volume of actual production. Those are called production subsidies. Example, subsidies to railways, subsidies to village and small industries. These are the examples. On the other side, product subsidies. Product subsidies are given per unit of product. Per unit of product. That is food subsidy, petroleum subsidy, fertilizer subsidy, etc. These are the differences between production subsidies and product subsidies. Next, what is the difference between factor cost and market price? Factor cost and market price. Factor cost is equal to market price minus net indirect taxes. Net indirect taxes means indirect taxes minus subsidies. So factor cost is equal to market price minus net indirect taxes. Therefore, factor cost is equal to market price minus indirect taxes plus subsidies. Indirect taxes plus subsidies. Then you will get factor cost. On the other side, market price is equal to factor cost plus net indirect taxes. Net indirect taxes means indirect taxes minus subsidies. So market price is equal to factor cost plus indirect taxes minus subsidies. This is the difference between factor cost and market price. Factor cost and market price. Next, what is the relationship between factor cost and market price? Relationship between factor cost and market price. So market price is equal to factor cost plus indirect taxes minus subsidies. In other way, market price is equal to factor cost plus production tax plus product tax minus production subsidy plus product subsidy. So then you will get market price. So both taxes are added to the factor cost. Both subsidies are subtracted. Next, then you will get a market price. Next, relationship between factor cost and basic price. Basic price, not market price. Basic price. Basic price is equal to factor cost plus production tax minus production subsidies. Production tax minus production subsidies. So then you will get a basic price. Next, relationship between basic price and market price. Basic price and market price. Basic price is equal to market price minus product tax plus product subsidy. Then you will get a basic price. So these are the some of the concepts which are included in the national income accounting. So thank you for watching. Like, share, subscribe and comment.